Hello, everybody, and welcome back to another session of the 24th Goldman Sachs European Financials Conference. This year's conference was supposed to be in Rome, but this year we will literally bring Rome to your home. I'm today accompanied by Mr. Daniele Franco for this recording, and as far as I know, he's definitely sitting in Rome at the Bank of Italy, and we will have the pleasure to listen to his comments and thoughts about the current situation through this recording. So first and foremost, Mr. Franco, thank you very much for making the time to participate to this conference today. I know your schedule is busy. I know the central banks around Europe are extremely busy, so we appreciate greatly you taking some time away from your diary to be here with us today. Now, I just wanted to make a brief summary of your career. I'm sure I'm not going to do justice to it because it's very long and illustrious, but I'd highlight that you're currently the Senior Deputy Governor of the Bank of Italy and President of the Insurance Supervisory Authority since January 1st, 2020. You have a long career starting at the Bank of Italy in 1979, but also including important roles at the European Commission's Directorate General for Economic and Financial Affairs, as head of the public division of the Economic Research Department, in Italy, State Accountant General, and in the field of academia, published books on public spending, social protection systems, European tax rule, and many other subjects. So a very rich breadth of experience. I know that on all of these topics you have thought that you wanted to share with us, so I leave the floor to you now. And again, thank you very much for participating to this conference today.
Well, thank you very much for inviting me in this kind of unusual context. Hopefully, in future year, we will go back to more normal conferences and meetings. But so, anyway, I'm glad to contribute in this way. How would you like me to get started?
Absolutely, go ahead and share with us your initial thoughts.
Okay, I think we are living very unusual times, and let me mention what we did at the bank in recent months to cope with this unusual crisis, and then I'll say something about Italy's economic context very briefly. I think the shock has indeed, the virus shock has indeed been large and unexpected. At the bank, we had at the end of February, beginning of May, two main concerns. First, to ensure that employees were not affected by the virus. Second, to make sure that services were provided to the public in a full way. So by means of services, I'm referring to monetary policy operations, supervision, statistics, economic analysis, the payment system, public debt management. So we wanted to make sure that everything worked well. In the space of about 10 days, we moved about 90% of our colleagues from working at the office to working at home. The process was rather smooth. In the end, it was easier than we expected in the very beginning, basically because the technology was already there. We did not suffer any significant cuts in our output, and all departments were always fully operational. If you read our annual report, which we released at the end of May, you would not think that it was produced by colleagues, economists working from home. We are now planning a gradual return to normality, which will depend on the evolving health as well as on government decisions and policies. But an important point here is that the experience we are getting from this strange new context, I think will be very useful in designing the future organization of work at the bank. I think we will draw a lot of indication, but this applies to the Bank of Italy, but I guess also to many other institutions and companies. Moving to broader issues, while the public health situation in Italy is gradually improving, the economic situations remain very difficult. Italy recorded a fall of GDP of around 5% in the first quarter. And we expect an even bigger decline in the second quarter. For 2020, we expect a reduction of GDP in the range of 9 to 13%. There is obviously a lot of uncertainty, which reflects the fact that health developments are very much uncertain. Now things are, as I said, improving fast, but I mean, hopefully this will continue, but certainly nobody is certain about that. The government macroeconomic outlook envisages a deficit of around 10% for this year, and an increase in the debt to GDP ratio of about 20 points, meaning that Italy will have at the end of the year a debt to GDP ratio of about 156 points. That is very high. Larger fiscal measures have been implemented by the government to support households and companies and to sustain the recovery. As everyone knows, the important monetary policy decisions have been taken by the ECB, and EU institutions are also acting in order to provide financial support to countries by the crisis. We expect the economy to pick up in the second part of this year and to accelerate thereafter. For next year, we expect GDP to grow at about 5%. Now, as it is well known, Italy's growth over the past decades have been rather disappointing. That's for a number of reasons. And we have a number of weak points. For instance, we know that doing business indicators are rather unsatisfactory. The tax rates on labor are rather high. The ratio of investment to GDP is lower now than it was in past decades, and the size of companies is relatively small. On the other hand, we are aware that Italy has a number of points of strength, like the flexibility of the manufacturing sector, the capacity to export, the relatively low debt, both of households and companies, the big trade surplus, which is about 3% of GDP, and it is still high also in structural terms. So overall, we think that now it is crucial that Italy exploits this unexpected and painful shock due to the virus to overcome the main obstacles to growth. This is in a nutshell, I mean, rather a quick picture of the Italian economy right now.
Okay, thank you for these remarks, Mr. Franco. Look, the first topic I wanted to address with you, which I think is the elephant in the room, is the Italian debt sustainability. As you said yourself, the debt to GDP ratio is likely to reach close to 160% at the end of this year. And whilst many economists expect a snapback, very rapid, for GDP growth next year, there is also a risk, in many people's opinion, that the high debt ratio of Italy might necessitate more austerity, as was the case before, and risk hampering that rapid recovery, further putting pressure on debt sustainability. What is your opinion?
Well, I say that I would exclude that the risk that you mentioned will materialize in 2020 and 21. This for a number of reasons. Well, in principle, a contractionary fiscal policy in Italy might be triggered either by the need to respect the common fiscal rules or by tensions in the sovereign debt market. Now, concerning the rules, the EU Commission made clear that member states will be granted significant budgetary flexibility for as long as the crisis persists. Actually, Italy will be able to access to a significant amount of EU resources. So contrary to previous crises, this time EU institutions are contributing to expanding, not restricting Italy's fiscal space. Concerning the fear of market turmoil, let me first mention that the worst months in terms of public liquidity needs are behind us. And even during these months, the increased state financing needs were accommodated in an orderly way. Moreover, the ECB schemes, the PPP and the APP, are stabilizing the financial markets while assuring a very easy monetary stance. Finally, in the coming quarters, Italian sovereign spread will also reflect the availability of the new EU-level financial instruments. So, for all these reasons, we think that the coming quarter, let's say, will be on a relatively safe path. Italy's public debt to GDP ratio is high, it's very high, but the cost of the debt is low and it is still declining. In 2019, the average interest rate on our debt was 2.5%. And we are now issuing a 10-year bond at 1.5%. This implies a further reduction in the average interest rate. So this makes the situation less worrisome than would be implied, but just by looking at a very high debt ratio. Obviously, Italy should not be complacent. Italy should implement a medium-term program for the reduction of the debt ratio. This implies that Italy should focus, as I said earlier, on growth-enhancing economic policies. And second, Italy should target and maintain a primary surplus, like Italy did in past years, and the primary surplus level should be sufficiently large to reduce the debt ratio. In our annual report, you may find some simulation pointing to a surplus of at least 1.5% on average. So reducing the debt ratio to a safer level will require a strong and protracted commitment by Italian policymakers, but I believe it can be achieved without excessively harsh measures.
Okay. Now, coming to buyers of that debt, banks and insurance companies have been and are a key source of demand for sovereign bonds, but many of them have expressed their willingness to rebalance their investment portfolio going forward slightly away from Italian debt and BTPs. How do you see the execution of this balancing act between large issuance needs and conservative or more conservative and diversified investment strategies by the key buyers?
Well, before the start of the epidemic, Italian banks were gradually reducing the stock of Italian government securities in their portfolios. Between March 2019 and January 2020, banks sold almost 40 billion of government bonds. That is from a peak of more than 400 billion in 2015. Government bond held by Italian banks had come down to 315. In recent months, as you said, net purchases of sovereign bonds by Italian banks have resumed. Between February and April, they increased by 46 billion to a total now of about 360 billion. And this because of the new market tension relating to the epidemic, but also to the fact that banks consider that a good thing to do, buying bonds with a relatively high yield. So the stock of bonds still represents less than 10% of banks' total assets, and this percentage is even lower for the largest Italian banks. There is certainly a need for some balancing, as you mentioned, between the Italian treasury issuance needs on the one hand, and banks' prudent investment strategies on the other, but I believe that this remains manageable. Banks, for instance, have allocated a large part of recent purchases to their cost amortized portfolio, which means that future variations in bond prices will not impact on banks' regulatory capital. Moreover, the risks arising from excessive volatility in government bond prices will be mitigated by the ECB programs, especially by the PPP, which was strengthened just like last week by increasing its total amount to 1,350 billion euro and extending its duration until at least mid-2021. At the same time, the ECB Governing Council has confirmed that purchases will continue to be conducted in a flexible manner over time across asset classes and among jurisdictions to stave off risks to the smooth transmission of monetary policy. As for insurance companies, while the sharp drop in the prices of financial assets, including sovereign bonds, and the rise in their volatility have led to a reduction in their solvency ratio, their capital remain well above the regulatory minimum. And this allows them to act once again as a shock absorber rather than as a shock amplifier. Obviously, after this emergence, it is likely that banks and insurance companies in Italy will once again reduce their stocks of Italian government bonds, so balancing will resume after the crisis.
Excellent. Now, moving on to the latest European Commission's proposal for a European Recovery Fund. This is supposed to be funded, or at least there is a project for it, by a federal tax, and its aim is to redistribute through grants. And this appears to have the key elements for deeper integration of European finances. This is in response to the COVID crisis, and some probably see this as a one-off. But do you believe that this is the beginning of some sort of a new paradigm for European and therefore Italian state finances?
Well, if you look at the history of the European Union, you can see sudden accelerations in integration in between period of stability. So this is likely to be another phase of acceleration in the integration process. You may remember the Monnet prophecy that European integration will be forged in crisis and will be the sum of the solutions adopted for those crises. So the Bank of Italy has repeatedly stressed that the EU economic framework is incomplete and that some kind of common fiscal capacity is necessary in the medium term. This capacity would protect member states from the impact of idiosyncratic shocks and complement monetary policy in the event of severe common shocks. Well, the new EU fiscal instruments, such as the Recovery Fund, represent a big step forward in that direction. The importance of this fund is twofold. First, what it will, one should look at what it will finance. And second, one should look at how it is raised. And here we see the recognition of a collective responsibility and the first steps toward a proper fiscal union. Basically, the EU is creating a kind of federal debt. And this allows the EU to run a small federal deficit to stabilize the economy in the current downturn. This also implies some redistribution between those who receive the resources and those who will repay the debt. Now, we will see in the coming years whether this is a major step forward or it is only a temporary solution. If we look at past European history, I would tend to believe that it is the former that is a kind of step forward. How big it is, we will see in the coming years.
Excellent. Switching tack and moving on to another remit of the bank, which is the stability of the banking system. Italian banks are very domestic. There is little foreign participation in the banking system, and the banks have historically have a fairly low profitability in a European context. So my first question here is, what is the most likely scenario that the Bank of Italy envisages for the rise in NPLs following the contraction in GDP? Is it possible that we go back to the previous peaks, or do you see the state guarantees, particularly for corporate loans, as a strong tool with regards to protecting the bank's balance sheets?
Let me comment first on your first comment, the one about the Italian banking system being very domestic. Well, before the global financial crisis, the value of cross-border M&As in Europe reached a peak, and Italian banks, I'm referring especially to Intesa and UniCredit, significantly expanded their presence in Europe, in continental Europe and Eastern Europe, while some major Italian intermediaries were acquired by foreign intermediaries, and specifically French intermediaries. Therefore, at least when it comes to the largest institution, the Italian banking system is fairly open. Then the process of pan-European integration in the banking sector came to a halt with the global financial crisis in 2008. The economic environment was clearly not favorable to cross-border M&As. Weak economic growth led to subdued bank profitability, this in Italy as well in other European countries. So afterwards, the banking union project has somehow revived the integration process, but we are still far from a fully integrated banking market, also because the banking union itself is still incomplete. So I think the issue then is not just Italian, but it has a European dimension, as it has also been pointed out by the ECB. And I believe that a completion of the banking union could work as a catalyst for future cross-border consolidation. Coming now to your question, well, the financial structure of Italian corporates is much sounder now than it was during the Lehman crisis and the sovereign debt crisis. The share of debt held by vulnerable firms, that is, firms with either a negative operating income or very burdensome interest expense, was 29% of the total debt at the end of 2018. It was 44% in 2007, much bigger. According to our estimate, the share of vulnerable debts could reach the peak recorded in the previous crisis between 2008 and 2011-12, only if profits in 2020 were to decline by 50%, which is a reduction much bigger than the one that we observed in 2009. So Despite the severity of the COVID-19 crisis, this scenario seems unlikely at the current juncture. According to the estimates prepared by my colleagues here at the bank as part of the Eurosystem staff macroeconomic projection published a few days ago, even under the severe scenario of those projections, while the flow of new NPLs would rise, it would remain much below the values that were observed during the Lehman and the sovereign debt crisis. Public loan guarantees will help to contain the amount of value adjustment, both on new disbursement, on new loans, and on outstanding loans subject to renegotiations. It is, however, likely that in the coming months, the economic impact of the epidemic will appear on loans already classified as unlikely to pay, which benefit to a very limited extent from the measure introduced by the government, the guarantee measures introduced by the government. And these loans are about half of the net impaired loans on bank balance sheets. According to our simulations, if all the unlikely to pay loans were transformed into bad loans, that is in a very, kind of harsh scenario, the increase in the value adjustment would be approximately for the Italian banking system 15 billion, with an average reduction in better quality capital equal to 1.1% in terms of the risk-weighted assets. So it would be a big impact, but still a manageable impact. NPLs are less of a concern in the household sector. At the end of last year, the yearly non-performing loan rate was at a very low level, about 1%. The share of household with a mortgage loan classified as vulnerable was about 0.8% at the end of 2018. That is half the level of 2007 when it was 1.6%. Moreover, the share of new consumer loans granted to borrowers classified as high-risk borrowers fell from 9% in 2012 to 2% in 2019, while the share of low-risk loans rose from 36 to 48%. So on the household side, we are on a safer ground. And we are on a safer ground also because of a number of measures taken by the Italian government over the last few months, supporting households' ability to meet financial obligation, talking about a debt moratorium and expansion in unemployment benefits, a temporary income support scheme for the self-employed and seasonal employees, and finally the freezing of layoffs in the Italian private sector.
So the system, as you pointed out, has started to consolidate under the impetus of the Renzi reform in 2015. Since then, the consolidation has happened mostly through distressed transactions. And even in what was a more normal environment, domestic players, even earlier in the year, have been resisting consolidation appeals. How desirable or likely is further consolidation in the system?
Well, first, let me mention that some consolidation has already taken place in recent years, notwithstanding the difficult economic environment. For instance, as a follow-up of the reforms of the larger cooperative banks, what we call the Banche Popolari, two of them merged and created one of the largest banks in the country, Banco BPM. Moreover, an important reform of the mutual banking sector, what we call the Banche di Credito Cooperativo, was enacted and implemented. Since last year, more than 200 small neutral banks have been operating under the umbrella of two large cooperative banking groups, ICREA and Cassa Centrale Banca. So this has significantly strengthened the sector. Now we have in Italy 98 individual banks and 55 groups, with the 12 groups owning about 80% of the overall assets. The system has become more concentrated than it was in the past. About 10 years ago, we had about 700 banks. A further operation is currently underway following the public offer announced by Intesa Sanpaolo for the acquisition of UBI Bank. The Bank of Italy and the ECB have positively assessed this operation from a supervisory perspective. The process now requires the authorization of IVAS. IVAS is the insurance sector regulator. Then there is a need for the authorization of CONSOB, which is the market regulator, and the antitrust authority. The antitrust authority in a recent preliminary assessment has raised some concerns about possible threats to competition in the market. So we will see how these concerns will be dealt with and considered. A process of consolidation is underway even right now. And in our annual report, we published a study concerning potential gains from consolidation in the Italian banking sector, pointing to the fact that there are still margins, useful, efficient margins for consolidation. So in this in-depth analysis that you can find in chapter 13 of our annual report, we show that increasing the operating scale of Italian banks can lead to significant efficiency gains. Specifically, the marginal cost of the production and distribution of highly standardized services for which the use of new technologies is important, such as payment services and deposits, significantly decrease as volumes increase. On the other hand, the study shows that economies of scale are rather limited for the provisions of loan and for investment advice, for which the use of new technology so far has been more limited. Overall, a growth in the scale of production via M&As or platform for sharing products and services could result in substantial efficiency gains for small and medium-sized Italian banks, especially if accompanied by restructuring of the branch network and by more widespread adoption of new technologies. For larger banks, further benefit from economies of scale on the cost side seems to be concentrated on business models that focus on high product diversification and operate with a relatively small number of branches.
Okay. And lastly, on the banks, I just wanted to ask you, we've now suspended the resolution and recovery directive, and essentially bail-ins have been eliminated as a crisis response tool. Yet the COVID pandemic might create capital needs for certain banks. Some of them were already vulnerable, some smaller institutions and fewer than before, but still some of them are still vulnerable and being closely monitored. How prepared is the state to help further if needed at a time when the rest of the banks might not be ready to shoulder more costs as they are also dealing with their own balance sheet pressures?
As the Governor Visco explained when presenting our annual report a few days ago, Italian banks are facing the current crisis from a stronger position than the one they were before the double-dip recession of 2008-2013. The ratio of the highest loss-absorbing capital, CET1, to risk-weighted assets rose from 7% in 2007 to nearly 14% last December 2019. Moreover, balance sheets have been cleared of most non-performing loans, which have fallen by 2/3 over the last 4 years. Notwithstanding this progress, the depth of the recession will inevitably affect banks' balance sheets in the coming years, especially those of some banks. The increase in non-performing loans will have to be dealt with in a timely manner using all available instruments, including those for the and sale on the market. And should it prove necessary, we must stand ready to explore a solution to safeguard the system stability, considering the use of preventive tools to help banks that are facing severe, also temporary difficulties. Recourse to public funds to support banks have been relatively lower in Italy over the last, let's say, 15 years than in other developed countries. However, when necessary, the Italian government has undertaken effective intervention in support of the financial system. So I trust that if necessary, our government will again take effective measure. And by the way, we welcome the recently introduced measure taken by the Italian government to facilitate the orderly liquidation of small banks. However, we continue to be concerned about the inadequacy of the European bank crisis management framework, about which the governor and other colleagues have spoken on many occasions. The main critical point is the lack of an orderly liquidation procedure for small and medium-sized banks. That is the vast majority of banks in the euro area. So progress on this front should be made soon in the context of the overall work on the completion of the banking union.
Excellent. And look, my last topic is essentially the marriage of the two topics before. It's monetary policy transmission and banks. Over the past many years, since the double-dip recessions, the growth of performing credit at Italian banks has underperformed that of the more wider spectrum of peers across the Eurozone, particularly France, to take one that I cover closely. Yet interest rates offered by banks on these loans have fallen significantly. And in many product cases, they've been on par with some of the interest rates offered in other countries. So what do you attribute this lack of credit growth to, considering those low interest rates? Is this a demand or a supply issue?
We think it is basically a demand issue. So if we look at the period before the outbreak of COVID-19, lending growth to household was solid, positive, but lending growth to non-financial corporation was negative. And this was mainly the result of low demand for loans by firms in connection with weak economic activity and investment. Overall, according to the Italian bank's reply to the Euro area bank lending survey, loan supply remained relaxed, also thanks to the ECB accommodative monetary policy stance. So some signs, some indications of greater difficulties in assessing credit were only reported by specific categories of firms, such as small companies and those active in the construction sector. Since the outbreak of the epidemic, lending to firms has accelerated dramatically, reflecting the higher demand for loans connected with liquidity shortages and connected with the declining revenues of companies. On the contrary, lending to households has slowed down following the contraction in consumption expenditure, following the decline in consumer confidence, and also following the decline of transactions in the real estate market.
Very clear. Now, switching tack slightly, but in terms of the provision of credit since the COVID outbreak, there are large corporate guarantees Italy has a very large program as well. Yet, when we look at the numbers which are floating around and being disclosed by the authorities, the take-up of these guaranteed loans in Italy seems to be fairly low in the context of what we can see elsewhere. Are banks cautious in granting those loans, or is it corporates being prudent on debt levels? What do you attribute this to?
Well, the slow take-up of public guarantees, multiple factors. Again, we examine these factors in our annual report. Well, first, one should consider that the volume of applications has been and still is exceptionally high. Second, some banks faced organizational problem. Third, and most important, the procedures required for implementing the measures are complex and involve numerous actors. So basically, the government had to strike a difficult balance between conflicting needs. On one hand, the need to rapidly channel resources to companies affected by the recession. On the other hand, the need to safeguard public finances, ensuring that guarantees do not extend to loans with a very high risk of default and are not susceptible to criminal use. So in the absence of any explicit regulatory provision, banks that fail to conduct a creditworthiness assessment expose themselves to the risk of committing a crime. Mm-hmm. Intermediaries are also required to carry out the control provided for by the anti-mafia and the anti-money laundering legislation. So now these aspects are going to be tackled with some amendments to the legislation, introducing guarantees, amendments which are under discussion in Parliament right now. So this will help, let's say, banks in carry out a procedure in a faster, in a speedy way. So I'm confident that in the coming weeks, with these amendments, these changes to the recently introduced legislation on one side, and the cooperation of all parties involved on the other side, including obviously banks, we will see substantial improvement in the flow of resources to the economy. Actually, the flow of loans to companies is increasing faster. Altogether, to facilitate firms' access to bank credit, public guarantees have been made available in the amount of 500 billion euro, which is 6 times the amount of guarantees available at the end of 2019. We believe that this amount is quite large with respect to the potential demand for guaranteed loans by Italian firms. We are monitoring the process. There is a task force set up by the Ministry of the Economy and Finance, together with us and the Banking Association, to monitor the execution of the new legislation concerning guarantees. And this task force released a few days ago its latest press release, pointing to the fact that the Central Guarantee Fund had received at the beginning of June about 500,000 applications for a total sum of 22.5 billion euro. Most of the application, 90% of these applications, are for loans of up to 25,000 euro, that is small loans, for which the state guarantee is 100%. But we are monitoring the process, and we expect to see, we see some progress, and we think that the situation will improve fast in the coming weeks.
Okay, so my last question is very simple at the end, and it takes into account all of your answers so far. So do you believe that an economy such as Italy which is intermediated mostly by comparatively smaller scale domestic banks that can have the same effect in supporting the economy, not only in the crisis, but also in its recovery? And how do you see the prospect of banks and capital markets union from an Italian perspective? How useful would direct lending by the central bank, as in the US, be at this stage? Particularly taking into account your last remark about the speed of processing by banks, which might have been slower than you might have expected.
Well, I mean, the development of financial markets in Italy reflects the characteristic of the economic system, reflects the structure of the economy. We have an economy with very many small and medium-sized companies. So the small size of our non-financial firms is mirrored by the size of the banks. Then the reliance of small firms on bank credit as a source of external finance contributes to limiting the scope of market-based finance. So small and medium-sized companies and a bigger role for banks and a smaller role for the financial market. However, over the last decade, the depth of financial markets have increased. Recourse to bonds and equity has increased. And these developments also reflect the significant measure taken by government to strengthen and diversify firms' financial structures. In particular, tax and regulatory barriers to the issuance of bonds were removed. A tax credit for listed SMEs was introduced. An allowance for corporate equity, which reduced the tax bias in favor of debt, was introduced and abolished, then introduced again. Despite these developments, Italian financial market, as you said, remains small compared to those of other large European countries. We think it would be useful to have bigger and more complete markets. But for specialized operators and specialized infrastructure to be profitable, one will need larger and liquid markets. So therefore, the project of the Capital Market Union, with its objectives of broadening non-bank sources of financing and lowering barriers to cross-border investment, I think they are particularly useful for Italy to further develop the Italian market finance. Furthermore, as you well know, the ECB is providing direct support to the real economy through its corporate sector purchase program, which is in place since 2016. And which was extended in March to include short-term commercial papers in its purchases. Now, if you look at the United States, yes, I think there you have a different financial market, but also you have a different economy. The measures adopted by the Federal Reserve to directly support credit provision to companies mainly reflect the larger role of capital markets in firms financing there, and the need to provide access to credit in a period in which these markets are experiencing severe financial threats. So it's a different economy. In the euro area, the combination of public guarantees on new loans and the set of a highly expansionary monetary policy measures adopted by the ECB have the same objective of supporting the flow of credit to firms, but they take into consideration the greater role of banks' intermediation in business financing in the euro area. So US and euro are two different areas, and you have to use partly different tools.
Excellent. look, this was very clear to me. I learned a lot today. This brings my series of questions to its conclusion. I hope that you enjoyed the session as well. I wanted again to reiterate my thanks for having taken some of your precious time to be with us today. I would hope that we will meet physically again very, very soon, and to welcome you in person and shake your hand physically, not virtually, next year at our conference, which hopefully might be in Rome as well, who knows?
Well, hopefully it will be in Rome as well, yes, yes. So thank you very much, and let's look to future meetings in a more normal and pleasurable context. So thanks a lot.
Absolutely. Thank you, Mr. Franco.
Bye-bye.